appreciate everybody coming today. I'll try to keep it a little bit at a higher level and not too much detail. I know taxes can get a little bit slow at times, so please, I'll try to keep things moving. First 30 minutes, I'll try to go through some slides to maybe spur some questions or thoughts. We'll leave the last 30 minutes to any questions that you might have, or if you want to come up afterwards. I know sometimes with this being financial in nature, it's not necessarily questions you might want to ask in front of a group, so feel free to come by and see me afterwards. This presentation is a presentation I've used at other meetings and events, so there's more than just taxes to it. We'll focus on the tax slides today, but if we have time or if there's something else, please feel free to ask as far as business risks or other maybe legal entity formation questions. I didn't print the slides out because we're in this day of technology that I feel like producing more paper is not something any of us need. So if you would like the slides, please leave your business card. I'll email them to you after the presentation. There is a sheet here for you to just jot down notes or questions. So usually I like something to write on when I am at somebody's presentation. So that's there. It also has contact information on the bottom, my direct contact information, and it's also throughout the slides. Notes, 30 minutes, questions, and cell phones. Just try to make sure maybe if you have those silenced. Please feel free to get up and use the restroom, get coffee, whatever you might want to do throughout the presentation. So with nothing more, I'll go ahead and get started. That's just a little bit about our firm. I acquired the firm in 2017 in Grain Valley. It might seem like a little bit of a distance, but you can get here to this office in about 10 minutes. So we're really very close to the Blue Springs business area. This is the team. We have a very diverse group. Judy has 38 or 40 years accounting experience. One thing that's very interesting about her, she worked at AT&T. And when she was at AT&T in the early 70s, she could not work in the accounting department. And I thought, well, that's odd. AT&T knew that closing the books at a quarter end would require overtime, and the state of Missouri had a law on the books at that time that women could not work overtime, so therefore they would not allow women to work in the accounting department. And I'm like, wow, that seems so unbelievable in this day and age that that would still have been something going on at that time. So real quick, as I've built this presentation, I have feedback from various attendees or even folks from my office, and they say sometimes we're not sure that people understand some of the basics. So Lorne, don't start at a high level, start with some basic information. So be aware that the tax brackets are graduated. Sometimes you'll hear people say, oh my gosh, that puts me in the 24% tax bracket. Well, that's true, but your income until you get there is taxed at some of the lower tax brackets. So you can see a married filing joint filer is up to 19.4 and 10% bracket, and you go all the way up to $78,000 for the 12% bracket. 22 is up to 168 and 24,321. So as you earn additional income, you migrate through those brackets. So not all of your income is just taxed at that highest level. So I just want to make sure that that's some base understanding everybody has. Tax entities are not the same as legal entities, and this is probably one of the things I hear incorrect statements on most frequently. Everybody will come in and say, well, I'm an LLC. And Scott, you probably hear this all the time as well. And I'm like, but how are you taxed? Well, I'm taxed as an LLC. No, the LLC is your legal organization. You're either going to be a sole proprietorship, a partnership, an S Corp, or a C Corp. So that is election or selection that you make at the time you set your business up. Probably one of the most common problems I see with this is someone will go form a business with a husband or a wife together, and they'll want to just have it go on their personal tax return, but because they have a two-member LLC, it automatically defaults to a partnership, which then is going to require an additional tax return. So as you're getting ready to set up a business, and this is for anybody here that isn't already in business, and I know a lot of us already are, but if you have friends, have them seek some counsel as they're setting that up, because you can inadvertently wind up in an entity that you don't mean to be in. And anymore, that's easy to do. The IRS has, when you go through and apply for your federal ID number, they're doing it through like a question and answer, and you go through screen by screen by screen to get your ID numbers. And you may not necessarily understand the impact of all the questions that you're answering. So even if you have talked to someone just for a little bit, I think it's time well spent to make sure that you get in the right entity format. A couple things about that, sole proprietorships, they are the simplest form of entity to set up. It goes on your personal tax return. Your taxes can be higher though than in some of the other formats due to you're going to pay self-employment tax on that, and that's 15.3% in addition to the income tax that you're going to be paying. So they do have that tax disadvantage, although you do get a credit for half of that self-employment tax on your personal tax return. But that's going to be your most common entity. As the owner, you cannot be an employee. Sometimes you'll hear people say, oh, you need to incorporate so you can be an employee and you can write your salary off. There are times, and I'll give you an example, there are times when that makes sense, but there's also times when it's not necessarily prudent for the additional cost you're going to incur from having to file a corporate tax return or do payroll or those types of things. Partnership, we see these used a lot for real estate type investments, and we do have several entities that two people go together to form the business, and the partnership is the entity that they choose. So, again, you'll have a separate tax return there in addition to your personal tax return. S Corp is a small business corporation. It was set up to try to make the corporate format a little bit, I guess I would say, easier for your small businesses. You are limited to the size that you can be in being an S corporation. And then you have C corporation. The S corporation, something that some people don't understand when they set these up, is when the S corporation earns income or makes money, all of that income flows through to your personal tax return, and you pay tax on that income at your personal tax return level, whether you've taken any money out of the company or not, okay? And that can be more of a consideration when you're in a company that's growing and you're constantly plowing everything you're making back into the business. You don't have a lot of free cash flow for taxes. So something to consider when you look at setting up that type of organization. C corporation, think of like your Coca-Colas or your large corporations. These file their own tax returns, set up as their own entity. The disadvantage to this is when you pay dividends out of these to yourself, you pay tax on those dividends. So the corporation will pay tax on the income inside the company as it earns it at the 21% tax rate. And then when you send a dividend out to yourself as one of the owners or shareholders, you will pay tax on it as well as a dividend. So when you hear double taxation, that's what creates that. The company has paid tax on it, and then you as the owner, when you take a dividend, have to pay tax on it. And the S corporation, as I talked about, that income flows out to your personal tax return. The benefit to it is you do not have the dual taxation, but you do have to pay tax on it as it earns the money. This is just to give you a distribution of sole proprietors to S Corps, C Corps. You can see by far and away sole proprietorships are the largest majority of the small businesses that you'll see out there. And that's going to include a lot of people that are mowing lawns or grass or turning a wrench on a car in their garage. There's a lot of small businesses out there with just one person doing something. Tax deductions are things to consider. My first advice I tell everyone is don't go to extremes, okay? Don't say everything is business, all right? And Scott, maybe you can talk to this as well as what you see in your practice, but people will come in and they're running everything through the business. And under exam, that's not going to stand up. I'm sorry, the IRS is going to say, how are you paying for your personal cell phone? Or you don't have another car and you've got everything going through the business. Don't be extreme. Give them a bone. Throw something to them. Say, hey, 20 or 30% of your cell phone bill throughout the year is personal, and the other 70 or 80% is business. Because when you go to extreme and try to run everything through the business, it's just not going to hold up. And what I tell people when they come into our office, I'm not the accountant that's going to lie, cheat, or steal for you, okay? We're going to prepare the return in such a way that it's going to survive under exam, the positions we take. And so that's what I would encourage you, as you hear friends or you have people telling you things or giving you tax advice, and they're like, oh, you should do this, or you should run everything through the company. Just be wary of that advice and understand that your situation may be different than theirs, okay? Vehicle mileage deduction, the vehicle in the business, if you're first starting out as a small business and you're using your vehicle primarily personally and some for the business, make sure and just hold it personally. Don't put it into the business, because I think a lot of people don't understand that if you have a vehicle you've placed in the business, the mileage you drive it personally is income to you and should be on your W-2 or some way you need to recapture that as income. So when you put the vehicle 100% into the business and are deducting everything there, the fact that you're driving it personally is income to you. So something that I think is an aha for a lot of clients when we visit with them. Cell phones, we talked about allocations. Office supplies, envelopes, postage. One of my clients said, Lorne, I think you need to make sure and tell everyone that those things that they're using in business, they need to capture and deduct. So those items that are legitimate business expenses, make sure that you're capturing those and including those in the expenses you're providing to us as the preparer. Trash service, you can do an allocation on that. Business use of your home. I think a lot of people will talk about business use of the home and trying to make sure they take advantage of this tax opportunity. Understand that it's an area of your home that's used solely and exclusively for business, okay? It's not your master bedroom that has a desk in it, or it's not the dining room that has, you know, the credenza desk, library desk there in the corner. It needs to be a separate room in the home. So where I most see that is like in a three-bedroom home, you'll see people have that third bedroom set up as an office. And so that's legitimate. The other thing to consider recently, and recent is a relative term, I think it was 2013, 2012, they came out with a safe harbor on the home office deduction where they'll give you a flat $5 per square foot up to 300 square feet. So rather than tracking property taxes, interest, insurance, all of that on the full home, you can just say, hey, this is the square footage of my home that I'm using for the home office, and you can take that as a deduction. If you don't do that, most of you are familiar that when you sell your home, you don't have to pay tax as long as your gain's under $250,000 or $500,000, okay? And so for most of us, we're not paying income on that. However, if under the old rules you were using your home office deduction, there is a component of that that's depreciation of your home. And when you sell your home, you have to recapture that. So you can wind up paying a little bit of tax depending on what you depreciate. Equipment replacement and timing. This is one that I love. I had a client, he had a little over $400,000 of income, and he comes in like Christmas Eve and says, oh my God, Lorne, what are we gonna do? I need to do something to lower my taxes. And I'm kind of like, I'm spending time with my family. We should have had this conversation, you know, August or September, okay? We talked about it after Christmas, and he decided to go buy a bulldozer, okay? So he spent $375,000 on this new dozer. And I said, Rick, I said, how many hours are on your current dozer? And he's like, well, I think there's about 500 hours on it. I said, how old is it? 10 years old. And for those of you who may not know, that's not a lot of hours on that piece of equipment. And so 50 hours a year he's using it. I said, what do you do with it? Well, it sits out at the farm and I'll clear stuff every now and then. He spent $375,000 just to try to save taxes. And in heavy equipment, you can recoup your cost, but many times that's not always the best decision. Plus, had we had this conversation in August or September, we could have looked around the country if he wanted a new dozer. At this point in time, he had to go to Foley, and they know when you come through the door on that last week of the year, if you're looking to buy a piece of equipment, you got to close if you want to deduct that. So I'm sure he paid more for that piece of equipment than he would have had he given himself a little bit more time. So if you'll come in, myself or Scott or whoever might be your tax preparer, visit with us. I always say August or September. You've got 6 or 7 months of actual, then we probably have a good idea of what the rest of the year is going to look like. And then we can start looking at, okay, what of your equipment, what are you spending a lot of time or money on repairs, or what's going down on you a lot? Some of my guys that are in the lawn and landscaping business, maybe they start replacing trucks because they've got some older equipment and it's spending time in the shop for transmission issues, other things like that. Well, that downtime is time they can't have a crew out running. So that's the time to be looking at when you purchase something, not the last week of the year, because it's hard to find what you're looking for and still get a reasonable deal. Meals are only 50% deductible. Entertainment is no longer deductible. And think about this as a Royals ticket, Chiefs ticket, Mavericks, theater, anything. I think the example the IRS used, anything that has a ticket with it, is non-deductible. And that was one of the changes with the 2017 Tax Act, okay? So meals are still 50% deductible. You still need to have your business purpose though as you're doing that. So make sure that, don't go to extremes, okay? Don't be buying everybody in the restaurant dinner, because when Patrick Mahomes did that the other day, he's not gonna deduct it, okay? And again, do not wait till you're in the plan. Keep going here. Any questions on that come up? Okay. Tax deductions to quit tracking, okay? I see people that will come into the office and they'll bring in a Ziploc bag full of receipts, all right? And there's this one lady, bless her heart, she's retired and thinks she's gonna get a deduction, and she'll bring it in and there's $2,800 worth of expenses in there, okay? And we can't even get close to deducting that. So and these may be last year's, I think we might be at 12.4, but your standard deduction is 12.2 for single and 24.4 for married. And what that means is when you talk about, or you hear people talk about itemizing on their taxes, is that if they're single, they have to get over $12,200 in deductions. And if you're married filing jointly, you have to get over $24,400 in itemized deductions in order for that to be of benefit to you, okay? Now, I would say in the single category, it's a little bit easier, particularly if you own your own home. For example, I own my home and I'm single, and so my monthly mortgage payments may be $1,500, and $500 of that's maybe principal and the rest of it's interest, let's say. So I'm very close at $1,000 a month to the $12,000. But then you add personal property taxes, real estate taxes, and my Missouri income tax that I have withheld, and I can get over that $12,200 fairly quickly. But when you're married filing joint, you still are going to have a similar house payment. And so you can get to the $12,000 pretty easy in that same similar scenario with the interest. But then, and if you're both working, depending on where your wages are, your state income taxes might get you that next $10,000 or $12,000. You can only deduct up to $10,000. And then the other thing that people miss is medical expenses. You can only deduct to the extent they exceed 7.5% of AGI. So what does that mean? That means if your AGI is $100,000, your adjusted gross income, you have to get over $7,500 of medical expenses before you can start deducting those. So you can deduct them, but they've put thresholds in there that make it even more difficult to deduct them. So before you spend a lot of time tracking all these receipts and all these medical costs that you think you're going to be able to deduct, talk to your tax advisor and see how close you were last year, or maybe what's going on in the current year. Sometimes we'll see people get into a situation where they have a lot of health issues in a single year, so that's the time to be thinking about that. The other thing, but the point of this is, don't spend a lot of time. I think what causes anxiety for a lot of people at tax time is trying to pull together all this information. And in many instances, sometimes we can't use it, so that anxiety could never have been there to begin with, okay? So just keep that in mind. And when they enacted the Tax Cut and Job Act of 2017, at that point in time, they said about 30% of tax returns were itemizing. They knew when making this deduction, this change in the standard deduction, they expected that to go to 5 to 7%. And I believe the intent was try to make it easier for the average American to go ahead and file their taxes and not have to worry about tracking itemized deductions. Tax planning strategies. Before I get into, I guess I've got bunching in here, so we'll talk to that. Renting buildings to a business. Not everyone has this scenario, but this is something that you can get into. For example, my brother owned a cable contracting company, and they had his trucks in the shed, and they stored the extra cable and those types of things. He could build a building, own it personally, and rent it to the business. Okay, that's something that you can be doing. Incorporating when the time is right to save on taxes. I tell folks, until your net income gets to, and net income, not gross, until your net income gets to $75,000 to $100,000 on a sustained basis, I wouldn't necessarily look at incorporating, okay? When you incorporate, you have another tax return to prepare, you have payroll records that have to be prepared on a monthly or quarterly basis, and so you will spend money with your tax advisor or your accountant, having those items prepared that will eliminate a lot of the tax savings that you will have. So for me, the example I use is when I go to Craigslist to buy something, I never want to pay full price, all right? I'm trying to get a deal on it, so I usually won't pay much over 50 cents on the dollar. Same way when I'm giving you tax advice. I'm not going to put you in a tax structure where I save you $2,000 and you pay me $2,000 in accounting fees to do it. I mean, you benefited nothing. I'm the only one that benefited from it. So I try to have that conversation with clients and say, listen, until you get here and you're at a sustained level, because you might save money one year. I have a client right now that we had this conversation. He wanted to move forward with doing it, but he works in the insurance adjustment business, and he'll go out and do contracting for the large insurance companies. Well, when you had the hurricane in Houston and the one in Florida, he had significant income that year, you know. And then he's like, oh, Lorne, I got to do something. I said, okay, we can do this, but be aware if your income goes the other way, it can cost. No, I think I'll sustain at $200,000. Well, the very next year, his income, he had almost 6 months that he didn't work at all. And so when it dropped over, he came back down to around $140,000, $120,000. He still saved by having that tax strategy in place, but it wasn't nearly as much in the prior year. So when you have volatility in the income, we also have to think about that and whether or not it makes sense to incorporate. Tuition reimbursement for employees. This particular item came from an IRS examiner. We as accountants have to go to continuing professional ed, and this was being hosted by a retired IRS agent. And she said, a lot of small businesses we think miss an opportunity when it's just a family that's employed and they can put a tuition reimbursement program in place when the kids are working for the company and pay for the college through the business. So something to have consideration, and I'm a big advocate for having kids working in your business anyway. I think it teaches them responsibility. They can pay for their own, you know, all of their own clothes, the car, all of those good things. So I'm an advocate for putting the kids to work in the business, and then there's other benefits that can go along with that. Retirement plans. This is something that I think as many small business owners wait too late or too long to try to start building it. And I'm probably just as guilty as anyone on that. Thank goodness for my time at UMB. But what you find is when you get out on your own, the business just keeps consuming all of your cash and you're plowing all of your free capital back into the business. I tell everyone when you start your business, you're maybe younger and you've got smaller kids, and I understand you don't have much opportunity, but maybe put some money in a 529 plan or something for your kids, $500, $1,000 a year. Put it in something that looks like it's going to grow, so maybe there's some savings and growth opportunity for college. Then once the kids get in college and they're somewhat out on their own, then that's your time to really shine. You've really got to, as a small business owner, try to start plowing and putting money away. There are ways to do that through 401ks. There's also new cash balance plans out there that you can put significant dollars away in, and you know, $200,000 plus a year, but you've got to demonstrate the ability to do it before you set those up. But there are opportunities to sink significant dollars, and we use it as we're looking at transition from one generation to another. We may use it as part of because the retiring generation needs the cash out of the business to help fund their retirement. The younger generation may not have the cash flow, or the business won't service the debt. So sometimes we'll use some of these higher end retirement plans to try to facilitate the cash transfer to the previous generation to lower the purchase price. So something to consider. Tracking vehicle mileage. This is not as cumbersome as it once used to be. There's Mileage IQ. QuickBooks has various programs for that, where you download the app onto your phone and it tracks where you go. And then you swipe right or swipe left as to whether or not it was business or personal at the end of the day or end of the week. And some of them will memorize your routes if you're running the consistent route each week. And then if you've said it was business in the past, it automatically knows to do that. So, and my clients tell me that those are $5 to $6 a month, so they're not terribly expensive, something that might be beneficial. Purchasing equipment for tax, we talked about that. Employing kids in the business. Bunching of charitable donation. This is something with the new higher itemized deductions. I had a couple come in and they give about $12,000 to $13,000 a year to their church. And I told them, listen, we need to consider you not gifting for a year and then in the next year do $24,000 or $25,000 to the church so we get over that $24,000 married filing joint threshold. Their concern was for the church. They said, well, what about the church cash flow wise? And I said, well, the church is just going to have to manage cash flow better because this is something that a lot of charitable organizations are seeing. They weren't comfortable doing that, so they stayed with just giving $12,000 or $13,000 a year and not deducting it. Just a little bit of a sales pitch here for Truman Heartland Foundation. So I've become involved with that group. They have donor advised funds where you can make contributions. So we can contribute the $24,000 or $25,000 into a donor advised fund at Truman Heartland, get the deduction for tax purposes, and then the client can release the money because it's a donor advised fund out of that fund to the church in $12,000 or $13,000 amounts like they were historically. So it gives the taxpayer an ability to make a charitable contribution and then still be able to release it in a manner that it doesn't hurt the cash flow of the charity themselves or the church or whatever the beneficial organization might be. Make sure the employer is paying business expenses. And Scott, I'm sure you saw this a lot. With the Tax Cut and Jobs Act, they eliminated the deductibility of unreimbursed employee expenses. And I saw it hurt a lot of people in the trucking industry, guys that were working in the railroad, anyone, maybe sales people that were out on the road that typically had been paying their expenses themselves for their hotels, for their mileage, for their meals. All of that deduction went away. And why? I don't know. I don't know if you've heard anything as to why, what the theory was behind it. I haven't either. I don't know if it was something just to balance the Tax Cut Act, but it really hurt a lot of working individuals. So the expenses are still deductible if they're paid by the company. Okay, so instead of the employees, and if any of you are there or loved ones or people you know, tell them, get the company to pay for it. Ask for a corporate credit card. Ask for those items to be paid for by the company. The company can still deduct those. It's part of the business, but the employee can't any longer. And even if you have to give up some commission or compensation, it's really a significant hit when you can't deduct those. So just something to be aware of if you hear that, or someone you know is going through that, have them shift those costs to the company. Start your business before leaving your current employer. I'm getting down to my 30 minutes here, so I want to be conscious of your time. I tell people this, and what I'm going after here is if you're looking at starting your own business, it's much easier to get a loan while you have a W-2 wage income than when you go out on your own as your business. And you might need that debt. None of us want to think about going into debt or doing that, but I will tell you, go mortgage your house, get a home equity line of credit on whatever you can or whatever you can get at least a line of credit on. Because as you get into the first, second, third year, there can be those unexpected downturns, technology investments, many things can come up where you might need that cash flow. And at 2 years in, it is very difficult to go get a loan if you're in that situation than had you done it before you left where you were employed at. So if you have friends or somebody or yourselves that are looking to start a business, I would encourage you to go look about getting those debt instruments in place prior to going out on your own, because you don't have to borrow it. You can leave the line of credit unused, but to have that access to capital or that cash is important. We talked about home office deductions, safe harbor, and there's other things that individually. Let me look here and see if there's anything. This was a situation, in what I'm trying to give here in a scenario, which I know is hard to read, but we talked about income being at a certain level. You have to, and you can receive some advice that I believe is not good advice from other preparers that might put you in a corporation and tell you to pay yourself a low salary, okay? So I had a client, no, I did not get them as a client because we had this conversation and they left. He was a lawn and landscape gentleman making $150,000 a year, and he was paying himself $1,000 a month in salary, okay? When you And what he was doing with the rest of the money was pulling it out as a dividend every other week. And that's a no-no from an IRS perspective, okay? When you incorporate, you have to pay yourself a reasonable wage. Now, reasonable is in the eye of the beholder, but it needs to be a reasonable wage. So my conversation with him was, at $1,000 a month, can you even pay your mortgage? He's like, no. And I said, so how can you articulate or argue that that is a reasonable wage to the IRS? And the reason he was doing it was the $12,000 that he was pulling out as a salary, he could pull the other $100,000 out as dividends and not have to pay the self-employment tax on it, that 15.3%. So it saved him a lot of tax, but under exam, you're going to lose. And they're going to reclassify a significant portion of that to salary, and then they're going to assess you penalties, interest, and you're going to pay all that self-employment tax that you would have paid before. So that's where I say we will do what we can to minimize your taxes, but we need to take positions that will be sustainable under exam. So that's just a thought there. And we talked about contractor versus employee. This is something else that I'll hear, it just causes me concern when I hear a client come in and say, well, I don't have any employees, I pay everybody as a contractor. If they're true contractors, that's great. If they're not, you can be in trouble. And the question I get is, well, how will they ever find out, Lorne? Well, let me give you an example. There was a brief time I was a CFO or controller for Security Savings Bank, and I get a call from the Kansas Department of Labor saying, hey, you're not reporting all your employees. I'm like, what are you talking about? I said, absolutely. And they said, well, we have these 3 people that we believe were employees of yours. We need you to, they assess penalties and interest and send us a notice on it. I called over the HR department. They're like, we don't have a record of those 3 people. I'm like, okay, good. I called over to accounts payable and I said, hey, have we ever paid these? Oh, sure. And I said, where'd we pay them out of? Well, out of the location in Wichita. Okay, so I called down to Wichita and I talked to the chief lender down there and I said, hey, I've got state of Kansas saying these were employees. And he's like, no, they were contractors. And I said, well, what were they doing? Well, we repossessed a storage facility, like what you see some of these storage marts, and had a whole bunch of junk in there, so we hired them as contractors to clean it out. And we told them once it was done, the job was over. I said, so did they have their own stuff? Well, no, they came to work. Did you tell them when to work? Well, yeah. And, were they doing other jobs? No. So what happened was, one of these 3 individuals couldn't find a job after he got done with the contract. And we all have bills to pay. You can hear the conversation at home, well, I don't care what the bank told you, go down and file for unemployment. So that's what happened. He went to the state of Kansas, filed for unemployment, and the state of Kansas says, we never see a record here of you being an employee. And he's like, well, I worked for the bank. I worked for them for 3 months. And then they're like, well, who else worked for the bank? And before you know it, you've got 3 people that the agreement up front was contractors, but the state doesn't care when you go through the test of were they working for others, who controlled when and where they worked, and did they provide their own, tools or supplies, or were you providing that for them? So we had to pay back taxes and everything on that. And that's the reason, don't let any of your other locations determine who are employees or contractors. Cannabis, this is something I think a lot of people are rushing into this area right now. There's a Rule 270E out there, which disallows a lot of deductions, a lot, okay? And so people are rushing into this industry thinking that they're going to make a lot of money, but when you get to start looking at the tax consequences of being there, because marijuana, cannabis is still an illegal drug, and because of that it falls under this, and the only thing that is deductible on the tax return is the cost of goods. So if you're hiring employees to run the store, if you're paying rent, you're paying insurance, all of those things are non-deductible. So you can get into a situation where you made, let's say, you sold $500,000, you had $250,000 cost of goods sold, and you have $250,000 net or gross profit margin, let's say, but then you have your rent and all those other things, and you come down, maybe you made, $150,000 after all that. Well, that's not what the IRS is going to look at. The IRS is going to look at that $250,000 up top. And so just be aware that there are significant tax consequences to that, and it is a complicated structure to try to get around that. And even when you do so, you can only minimize the impact. You cannot eliminate the impact.
Can I ask a question on that?
Sure.
So But the employees are being paid, and you have all those matching, they're having federal withholding and everything just like normal. So you're saying that the company portion is not deductible?
Nor is their wages.
Wow.
But how are you still paying taxes on something that the federal government
is disallowing?
Yeah.
Yeah, and that's yeah. Where was it? I've got one of them in here on that.
Isn't that crazy?
Yeah,
The problem is federal government says it's illegal, so that's
Exactly.
Right.
Yeah. Al Capone boasted they can't collect legal taxes from illegal money. He is wrong. They can't. Okay? So they still want their tax dollars, even if it's an illegal venture.
That's why they're allowing it. They don't care about people's health. They care about the tax.
That's right. Where are the dollars? And that's going to be an interesting debate because the 270E disallows so much of the expenses, it actually creates more tax revenue for the government. So they have this balance. If they legalize it, then 270E doesn't apply and they're going to see revenues go down on these. But I can tell you, and I've been looking through California, Florida, and many other states that are already there, how they're setting up the structures, and it gets very convoluted. You take the employees, you say, on this side of the door, they're in the warehouse, and on this side of the door, they're on the retail side of the shop. So the 270E only applies here on the retail side, but when they're working in the warehouse, then that goes into the cost of goods sold. So, and then they get into, are you providing other services? So the structures can become very, very convoluted. You still have to show some expenses there, but I've seen strategies around a 60-40 where you have the same employee working 60% of the time in the warehouse and 40% of the time in the retail shop. It will become very expensive from an accounting perspective because you have to make sure you're doing these things right. And I would tell you, even then, there's not enough history to say whether or not you're going to survive under exam because they're coming hard after them. So just watch it. It was one of those things that I thought early on this is going to be like the rollback of alcohol, the prohibition, and I thought, wow, there's going to be a 50-year run here. Need to look at getting into this. I'm from a farming background, so my brother and I were looking about seeing what we needed to do to get into the grow of it. And we got into some of this, and this really, at the grow level, most everything goes into cost of goods sold, so the 270E is not so much of it. What you get into is, everybody thinks you're going to make a ton of money of this, okay? So for example, in Colorado, an ounce of marijuana was selling for a little over $2,000 in 2015. By 2018, it was down to $1,043 an ounce, okay? So in 3 years' time, the retail margin went in half, okay? I've had clients coming through the door that are seeking investors coming in, raising over $1 million, and they're going to go build a new greenhouse, build a $3 or $4 million greenhouse, because they're going to produce everything they can. Well, your problem is, that's great as long as prices stay where that will cash flow and generate enough profit margin, even after the 270. But if and when the federal government repeals it, okay, now it's legal. Now you can grow it anywhere and move it across state lines. So now you can grow it in warmer environments for a whole lot less cost than what your greenhouse cost is. And once it's legal, you can put it on an airplane. So now you can bring it in from Central America, South America. I mean, it's like everything else. It will go to where it's cheapest to grow it, okay? And so all of a sudden, the sales price is going to drop dramatically, and the amount of money that you and your investors needed to pay off that $4 million greenhouse is going to go. And you can calculate the number of days until you go out of business. So I've tried to caution people as they go running into this. It's such a great idea. Be careful. Make sure you understand what the risks are and how the market can change on you. And who knows when they're going to. That's the problem. You don't know when. You don't know when the federal government's going to legalize it or not. So it's interesting. And I've heard from clients that are in the business that the applications that the state of Missouri went through, that there's not been similar treatment amongst all of the applications. Have you heard that too, Scott?
I mean, the
ones attached with the check and the cash?
Yeah, so all of those, because what's funny, and this is one of those things, and I'll stop after this story, but everybody that wanted to get into this, pretty soon somebody realized, hey, there's a business to do this. So they started creating the applications and send them in. Well, they used the same answer on this guy's marketing plan, on this guy's marketing plan, on this guy's marketing plan. But then when they got the results back, my client scored a 0 and some of the others scored 2 points. There was a point system on it. And so it's like, it was the same answer. We have the same company that submitted it for all 3 entities. So I went down to Missouri CPA Day down in January, and I let our senators know about this, and they're like, yes, we've heard of that. And what's interesting is they didn't do the grading, it was outsourced to a third party. And that third party had been hosting events on how to get your license approved. And the scuttlebutt is that 50% of the approved applications had been people that went through their presentations. So it'll be interesting. There's lawsuits filed, and I also understand that they're getting ready to put it on the ballot in Missouri, or they're out for signatures right now for November to try to get it for recreational use. So before the health, the medical marijuana gets resolved through lawsuits, it may already be a foregone conclusion that it's recreational and you move on. All right, let me pause a second. Any other questions on anything? Because I'm at 9:15. I know a lot of us have to get out of here at 9:30, and I want to be conscious of your time. Go ahead, Christina.
So I have specific questions
Okay.
because I'm looking to purchase a vehicle, and I've heard varying things. So
Okay.
I'm trying to decide,
Mhm.
lease versus purchase, and through the business, not through the business. Can
Right.
you go over that a little bit?
Sure. Are you going to use the vehicle, I would say 80% of the time or more in the business, or 100%? Are you going to have another vehicle available for use? So it will be your sole vehicle then. And so you'll be able to deduct those things to the business, but again, for whatever mileage you drive. So now you hear a lot of people talk about tracking their business miles. Well, in your instance, you're going to want to track your personal miles, because that's how we calculate the compensation back to you. Okay.
So I purchase it personally, or I purchase it through the business?
How are you set up? Are you a sole proprietor? Are you a C Corp, S Corp? S Corp. So it depends on how you're purchasing and what they'll do. Sometimes the dealerships want to put it in your personal name, and it depends on the person you're talking to. They can put it in the business name, and you can guarantee or things like that. It'll be interesting as you go in. It's fine to put it in the business, because then your property tax and everything will come out to that. But I see a lot of people say, well, the dealership wouldn't let me put it. They wanted it to be in my personal name, and they get persuaded to do that. We still will code those as a business vehicle, because practically it's being used in the business, but it would be best to have it in the business name. But sometimes we have to try to work with things. Okay? Because then it also comes through in your personal property tax report too. So then that's why if you can have it in the business, it's better. Okay. So, what other question? Yes, Miss?
I'm actually in a similar boat. I'm an S Corp and thinking of getting a new vehicle.
Yep.
I will use it. I drive a lot for work, as I'm sure Christina does. We have another vehicle that we would use mostly on the weekends and things like that. But I'd probably use the new vehicle 80% for work, 20%
Right.
after work, whatever.
Right. Yep.
Can you not? You can't just say like on your tax like 80% is business wise, 20% is personal.
Sure, you can, but under exam, they're going to want you to come back and say, okay, show us the mileage or show us the business purpose of these. So, other things I would tell you guys, just real quick, just from a personal, just practical business. I'm seeing clients that are losing money. We're catching it because checks are being dual presented on their checking accounts. So make sure you're reconciling your checking accounts timely, okay? And I believe the reason it's happening is because of remote deposit capture, all right? And the banks don't have processes in place, at least on the clients we're catching this, to where the same check number can clear multiple times, all right? And most likely the reason is banks have image capture, and so if they can't capture the check number, they can't have all those items rejecting. So they'll put either just all 9s in or all 0s. Sometimes you might see that on your checking account statement where the check is out of sequence because it didn't read all of the information when it ran through the scanner. But the problem with that is, and we've had one where it was malicious and intentional, and we've had more than that. And we've had a couple that I think it's just people They put the check in a drawer somewhere, forgot that they've already deposited it, and they come across it 6 or 8 months later, and they're like, oh, I never deposited that check. They pull it out, take it on remote deposit capture, and it clears the bank again. So we're seeing the same check clear the bank. In the instance that was fraud, we saw the same check clear the bank 4 times in a 3-week period. It was an employee that they fired. It was their payroll check. And so in order to milk the employer, deposited the same check 3 times. So just be aware of those things. Another reason to do direct deposit. They don't have a check that they can be clearing. Well, we're at 9:25, so we'll try to get everybody out of here a little early. Get your day started. So thank you for your time. I appreciate it very much.